Hi guys, welcome to this Money Control live stream. You're watching Morning Trade with me, Nandita Khemka. Tuesday morning, good cues coming in from global markets. GIFT Nifty hinting at a positive start. Of course, we have clocked in that 20,000 milestone in yesterday's session. Lots of cues to digest, lots of stocks to watch out for, and of course, a big market voice on where we are headed from here and what are the themes one should be watching out for in the current leg of the bull run. But, we also will be getting all your stock-related queries answered by a technical expert on the show. So if you have any queries, send them in to us on our YouTube feed and we will try and take them up. But before we do all that, let's take a look at the top headlines at this hour. Wall Street ends higher amid a rally in tech shares driven by sharp gains in Tesla and Qualcomm. Asian markets also opened mixed following the positive handover from US peers. Record close for Nifty on milestone Monday as the index scales Mount 20,000 for the first time ever. PSU stocks have led from the front in this leg of the rally, the GIFT Nifty, suggesting a positive start for the Indian market this morning. Oil prices remain unchanged as the market looks ahead to monthly forecasts from OPEC and the IEA. Brent holds firm above $90 per barrel. Gold, meanwhile, remains steady even as the US dollar retreats ahead of the US inflation print later this week. Among stocks in focus, watch out for Reliance as the global investment firm KKR will invest over 2,000 crore rupees in Reliance Retail at an equity value of 8.3 lakh crore rupees. KKR's stake in Reliance Retail will increase to 1.4% vis-a-vis 1.1% earlier. Also in focus will be L&T Finance. And not just the equity market, it was a milestone Monday for Virat Kohli and the men in blue as well. Kohli becomes the fastest batsman to reach 13,000 ODI runs, trumping even Sachin Tendulkar. Meanwhile, KL Rahul slams a dazzling century, making a sensational comeback after being out of action due to injuries. India, meanwhile, hammered Pakistan by 228 runs, scoring their biggest win over their arch rivals. Well, without any delay then, let me first bring on board Nilesh Shah, MD and CEO of Envision Capital, joining in this morning. Good morning, Nilesh. Great to have you on the show as always. We have hit that milestone 20,000 mark for the first time ever. And, whenever we speak to experts, they say that, 20,000 is just a number and it's a journey. So let me ask you, let me rather begin by asking you, if 20,000 or if it's a journey, what is the next destination?
Good morning, Nandita, and best wishes to all the viewers. I think it's a great day, great moment for all of us who have been on this journey and in this marathon of scaling 20,000. Yes, I agree. It's just a number. It's just a milestone. But I think this milestone is a reflection of a rising India and aspirational India. It reflects the strength of the economy and is an outcome of several policy measures which have been undertaken by the government over the last several years. So I think a great moment and a great phase to be in. Going forward, I still believe that the upside potential is quite significant, especially for long-term investors, given that the economy is expected to sustain relatively high growth rates. Corporate India is on a strong wicket. Balance sheets of banks are again very strong. So on the whole, I think we have a great confluence of amazing macros and some amazing micros put together, which I think is a perfect blend for equity investors for the long term.
Right, when you look at India, we are firing on all cylinders. We've established ourselves as the voice of the global south, at the recently concluded G20 over the weekend. And, growth-wise, we are in a much better place compared to the global economy. Markets, of course, at record levels. In fact, even if you look at what's happening in the world of cricket, we have managed to, stage a very strong performance yesterday, with the emergence of KL Rahul, in fact, making a strong comeback and Virat Kohli performing as well. What could go wrong, in such a bull market? Oil prices have, once again, we've seen a resurgence coming in, $90 per barrel. Do you think some of the macros, even inflation figures, are a little worrisome at the current juncture? It's temporary. That's what the RBI is saying. So, could these play a play spoil sport going forward? And would you expect some bit of consolidation to come in going forward?
Surely in the backdrop of some really strong economics, some really constructive geopolitical developments like the G20, advances on space and technology that we had in August, and the great advances that we are making in the field of sports, all of this essentially provide a very strong backdrop. But I think in the short term, we have to worry about where crude oil is headed. Clearly in the past, the $90 to $100, price of crude for a barrel, I think has been a tipping point. And any kind of price higher than this does tend to essentially make a dent in our macros. So I think, yes, that's surely worrisome. But we've got to see, for how long this sustains, because we've seen a spike in 2022 in prices of crude oil, which impacted our macros. But thankfully, the price of crude oil came down and they slid back to a very comfortable zone. It seems to be rearing its head again, but clearly, fundamentally, from a long-term structural point of view, crude oil prices have no business to kind of elevate higher. But in the short term, it's also the supply side dynamics which really play a role. So I agree that, yes, while we have a lot of positives, crude is essentially the single biggest monitorable that we have to be concerned about, because that has implications on our inflation rate, interest rates, and growth rates, and of course, our trade deficit and our currency. So it does impact stability of the macros to some extent, and that's a key monitorable that we have to watch out for.
Right. Let's also talk about the broader end of the markets now, Nilesh. Mid and small caps have largely driven the rally that we've seen. If you look at the AMFI data, you'll see that net equity inflows are largely driven by mid and small cap funds. Would you call this irrational exuberance at the current juncture, and would you advise investors to stick to the large caps?
I wouldn't call this irrational exuberance. I still think that the mid and the small cap is coming out of a hibernation after 5 or 10 long years. They have essentially been under a spell of long-term underperformance. And I clearly believe that the mid and the small cap space is still in a kind of a breakout phase. And that's purely because after a very long period of time, we are seeing a very broad-based economic growth. Unlike in the past, where our growth was driven just by some of the pockets in consumer sector, this time around, growth is very, very broad-based. And I think when you have broad-based, high economic growth, a lot of mid to small-sized businesses end up doing well. In addition to that, a lot of reforms like the GST or the digital public infrastructure, these are big policy reforms and initiatives which have somewhat created a level playing field for the mid and the small-sized businesses to go out there and address India as one large market opportunity. And I think the current upsurge that we are seeing in the stock prices is a manifestation of the kind of developments that we are really seeing. So I wouldn't yet call it irrational exuberance. Yes, in the last 6 months, there's been a strong outperformance, and therefore there could be some bit of a pause in the mid and the small cap space. But I don't think the journey is over yet. We're still in the early phase of a very, very long-term structural uptrend in the mid and the small cap space in India.
Right, within the mid and small cap space, we've seen a very stellar run coming in, when it comes to the PSU space, right? Railways, defense manufacturing and the likes. But, for those who want to join the party, would you say they are a little late to join the party now and perhaps, stay away from these overheated sectors? Because let's talk about, the rally rather, being driven by, the dynamics. It's largely driven by sentiment because, there was, of course, a multinational corridor announced this weekend, but it's an announcement. The contracts haven't really been awarded yet, right? So it's a sentiment-driven rally. So where are the stocks headed from here, and should one really join the party right now, or is it too late?
Well, I probably would advise a bit of caution on this pack. Clearly, because some of these pockets in the overall PSU SPAC are a proxy for metals, for commodities, where obviously in the very short term, you could have a lot of volatility. On the infra side, on railways, on defense, yes, I think it's driven a lot by some of the developments that we have observed over the course of maybe last 1 day or 1 week. So I think, and there's going to be a time or there's going to be some time lag before these announcements translate into order books and revenues and earnings. So I clearly believe that the markets have begun to factor in a lot of those long-term prospects. So I would probably think that maybe for the time being, stay off from this pack because there's been a strong upsurge. But I think when you see a sign of correction, when there is a correction, given that these stocks have rallied by maybe 50 or 100% over the last maybe few months, I think if there were to be a meaningful correction, it might become a very, very interesting opportunity to kind of get back into this trade.
All right, Nilesh, lastly, where do you think the next leg of leadership will come from? Banks have underperformed thus far. They've just about started participating. IT is under-owned. Would you say these are the sectors one should look at with an 18 to 24-month perspective now?
I clearly believe that, the long-term structural growth opportunities will revolve around 3 Cs, which is credit plays, consumer plays, and the capex plays. And I think within that, if we can spot some niche plays, some very specialized opportunities where businesses are driven by both growth and capital efficiency, I think that kind of a combination or a collection of businesses in your portfolio would end up probably creating the best compounding and wealth creation opportunities over the medium to long term.
All right, those are the pockets to watch out for. Nilesh Shah, thanks a lot for taking out time and joining in. It's always a pleasure speaking to you. Look forward to having another conversation pretty soon.
Thank you so much, and best wishes to you, your team, and all the viewers.
Thank you, Nilesh. Thanks a lot. Same to you. Well, with that, let me also bring on board our next guest for today, Sacchitanand Uttekar of Tradebulls Securities, joining in this morning. Good morning, Sacchitanand. Good morning, actually, given the fact that we have clocked in that 20,000 mark. I want to know your thoughts on where we are headed next. And secondly, I want to ask you, if you look at the Nifty 500 index, 9 out of 10 stocks are above the 200 DMA. Is it a cause for worry, given the fact that, it does indicate that we are probably in the overbought zone when it comes to the mid caps? What are your thoughts?
Good morning, Nandita. Definitely, it's a good morning, and the way Nifty has scaled above that 20,000 mark, it has been remarkable. So far, if you look at last 7 trading sessions, the rally has been very impressive, especially if you look at or compare this particular move with the decline that we saw from the levels of around 19,900 in July. It took almost 31 trading sessions of a decline, and that entire price range was covered in just a matter of 7 days. So definitely, this is a very strong sign of a bullish impulse, which is ongoing, and we don't see this particular impulse getting exhausted very immediately. So this particular move may extend towards 20,580 is what we are expecting for this particular series itself. Even if you look at the immediate data, it is corresponding well that 19,800 looks like a very dependable support, and this particular support can be trustworthy throughout this particular week. On the higher side, there are minor hurdles around 20,160, 20,200, but eventually we see even these levels getting surpassed. So if you look at the way Nifty has been performing, the way broader markets have been performing, clearly, this is a very strong bull run that has already been in motion. When it comes to Nifty 500, yes, the readings have been on the overbought zone, overbought state, but there are no signs of any exhaustion or distortion in trends. So we would, expect this particular momentum to get continued. In fact, if you look at Nifty monthly charts itself, the way Nifty monthly charts are shaping up, the ADX on the monthly scale is about to, cross that 25 mark, and this is a very strong sign of a very good directional momentum play. So we are expecting that, on an immediate basis, Nifty could scale towards 20,200. For this particular series itself, we have a target of around 20,580, and all these levels remain intact unless Nifty keeps on trending above that 19,800 mark.
All right, that's the view on the index then, but let's quickly talk about the stock of the day today, L&T. It has increased the buyback price from 3,000 rupees per share to 3,200 rupees per share. Remember, it's the second company to do that after BSE. After the shares were hitting new highs, they had revised their buyback price upwards to somewhere around 1,080 rupees or thereabouts. And now L&T has become the second company to do so. Buyback price is, of course, at a premium of somewhere around 10.5% to the current price, which is yesterday's close price. Looking at L&T, of course, shares are perched at 52-week highs. Last 1 month has been pretty good, 9% up move or thereabouts. Time to chase the momentum, wait for a dip to buy. How should one trade into this now?
Well, definitely any declines towards 2890, 2900 levels should be utilized to create some long positions. Chasing momentum may not be necessary because if you look at the daily RSI, it is already in a very strong overbought zone. And in case if the stock starts consolidating within this particular range of 3000 to 2850, I think that particular consolidation would be healthy for the next leg of the rally. So right now, I think even if we see a correction back to its 5-day exponential moving average or the short-term averages, which are placed somewhere close to around 2850 kind of a zone, I think that decline can be utilized to create fresh long positions. Chasing momentum may not be necessary.
Right, that's the call on L&T then. But let's talk about cement majors then. There has been some brokerage notes on the cement pack. In fact, last week, Jefferies had come out with a note where they had said that, cement makers had undertaken a price hike of 35 rupees per bag. And now this is the second price hike in the month of September. Nomura and CLSA have come out with reports where Nomura says that there has been another price hike in East India and cement prices have been hiked by another 35 rupees per bag. In the first week, as I mentioned, we had seen another hike. Now, CLSA is saying that the demand momentum is expected to continue and, but still they don't see a case for upward revision in earnings given the fact that valuations are pretty elevated when it comes to some of these cement makers. So, in the cement pack, Ultratech, India Cements, you have the ACC Ambuja, anything that's catching your attention, catching your fancy at this juncture?
Well, two stocks we have always kept it on our trading books as one is Ultratech Cement. If you look at the entire structure, even right now, the way it has been consolidating near that 8400 mark. Again, it's a very good opportunity to accumulate this stock. On a broader structure, we are expecting that this particular rally could continue right up to 9100. If you look at last few months, we saw very strong broad consolidation within this particular range of 8400 on the higher side and 8100 on the lower side. Now this consolidation saw a breakout last week. It looks like a bullish flag formation on the weekly scale, and the price targets are also corresponding with that particular level of 9100. So from a position perspective, we continue to recommend Ultratech Cement. The base at 8400 should be utilized, to add on the long positions, and on the lower side, the stop losses can be placed at around 83.30 on a weekly closing basis. The other stock which has always been on our radar is Dalmia Bharat. Even here, for the last few trading sessions, we have seen very strong momentum play. The positioning has been very strong, and even at this juncture, we are comfortable chasing momentum here. The base looks elevated at around 2300, where one can place the stop losses, and this particular move could extend towards 2500. So both the stocks can be accumulated.
All right, positive views on Ultratech as well as Dalmia. But let's talk about Reliance Industries. Where do you see that on charts, given the fact that, with respect to its retail arm, there is news flow that KKR is looking to invest another 2,070 crore rupees in the retail arm at an equity value of 8.3 lakh crore rupees. In fact, the stake is being hiked to 1.4% vis-a-vis 1.2% or thereabouts. And recently, Reliance, of course, has announced a partnership with NVIDIA, AI partnership. Stock has done fairly okay. But on the charts, where do you see the stock heading now? 2,856 is where the 52-week high is. But over the next couple of months, do you expect the stock to retest those levels?
Nandita, on an immediate basis, we are expecting a swing towards 2560. And this is why we have been recommending long positions here. Keeping a trading stop loss somewhere close to around 2465 on a closing basis, momentum can be chased. But if you look at the overall structure from a long-term perspective, the correction that we saw from the swing highs of around 2600, 2640, primarily looks like a classic zigzag correction getting terminated at 2400. So I think the base looks confident, and the next move on the upside seems to be evolving. We have some minor hurdles at 2560, but eventually once we see this particular level getting breached in this particular month itself, then we may see Reliance scaling above that 2700, 2780 kind of a mark. So I think overall the price structure is very confident. Even if we see some slippages towards 2450 from a portfolio perspective, the stock can be accumulated. The stop loss should be placed somewhere close to around 23.20 on a weekly closing basis.
All right, that's the call on Reliance Industries then. But let's take up some viewer queries that are trickling in this morning then. The first one is coming in from Prabhu, and he wants to know if it's the right time to buy into a Natco Pharma. Now the stocks have been under the weather. You know, yesterday it was down 8%. Over the last 5 sessions, it has shed 11%. On a 6-month basis, Sacchitanand, it has gained 50% or thereabouts. But do you think the recent underperformance is an opportunity to buy, or would you say avoid?
Nandita, I think the price structure is indicating a double top formation, and post that double top formation at around 9:30, we have seen a vertical drop. If you look at the weekly charts, it was trending above its 5-week exponential moving average, and it was holding on, above the same. And this week itself, the way Monday session has started, we saw a gap down opening, and that particular level of around 850 has been breached with a gap. So we don't see an immediate reversal or a revival in trend. In fact, we are looking at a price declining towards that 750, 730 kind of a mark. So I think one should clearly avoid building any fresh long positions here. The triple top, double top kind of formation is good enough evidence. We may see further slippages towards 740, 750 zone. Probably that is one level wherein the stock can be reviewed.
Right, that's the view on Natco Pharma. I hope that answers your query. But let's take up some other queries on the banking, PSU banking pack then. Snehal Kumar Patel wants to know your thoughts on a Union Bank. And I also saw a query on Canara Bank on our feed. This one is coming in from K. Naga. Canara Bank and Union Bank have seen a divergent trend. You know, if you look at Union Bank over the last 1 month, it's down somewhere around 2.5% vis-a-vis a Canara Bank, which is up somewhere around 9 to 10% or thereabouts. How should one look at some of these two stocks now? If one is invested in these stocks, should one look at booking profits, holding on for more gains, or how should one play it?
Well, when it comes to Canara Bank, definitely I would recommend a hold. In fact, last week on your show, we did recommend this particular stock for a price target of around 360. Even right now, I'm very comfortable with the fact that the price has seen a very strong vertical move of almost around 14%. But if you look at the entire structure, we are still comfortable with the price action evolving. We are in fact anticipating a move towards 470 on a positional basis, and that's why we have also recommended it to our clients from a portfolio perspective. Even if we see a decline in Canara Bank, I think 350 is an ideal support wherein the stock can be reconsidered even from a trading momentum perspective. The stop losses should be placed somewhere close to around 345 on a weekly closing basis. When it comes to Union Bank, I think the underperformance may still continue. We may see some catch-up moves here. But eventually, if you look at, if you compare both the structures, I think Canara Bank is far better and well placed for another leg on the higher side. When it comes to Union Bank, we may see multiple hurdles near to that 94, 96 kind of a zone, and we are not comfortable, building long positions here. On the contrary, in case if we see slippages below 88 mark, then probably the stock could again decline further towards 84.
Right, from banking, let's take up a query on IEX. Raja Pasala wants to know your thoughts on IEX now, how to trade into this counter. But, if you look at the stock, last 1 month it had staged a good 11% rally, but off late it has fizzled out, hasn't done much, at least over the last week or so. Should one remain invested in this one, or should one look at buying into this one, fresh rather, if it presents an opportunity?
Nandita, the trend still remains weak when we look at the broader structure. The low top, low bottom sequence still, looks continuing. There are hurdles within this particular space of around 145 till 150. So until unless we don't see a confident, monthly closing about the same, the major trend still remains weak. So in case if he is holding on to any of his long positions, probably you can keep a very tight trailing stop loss. 135 is the level below which we may see this particular stock again trending lower. So probably if in case if he's invested, it's better to keep his stop losses at around 135 and observe in case that 150 resistance gets breached and sustained. So as of now, I would not recommend any fresh long positions here. On the contrary, in case 135 is breached, then probably the stock can be considered from a shorting perspective.
All right, that's the call on IEX. Keep a stop loss, and then you can look at it. So that is the view. But with that, we've come to the end of the query segment. But Sacchitanand, before I let you go, what are you recommending for our viewers this morning?
Two stocks. The focus completely remains on the banking space, and ICICI Bank is one particular stock that has breached from a 14 days of consolidation. Now, yesterday we saw a blend of short covering plus long positions additions, and if you look at the daily RSI, it has started comfortably trending about that 50 mark. So we are expecting a positional move, a rally towards 1,000, and that's why we have a positional target placed somewhere close to there. Trading stop losses can be placed at around 973 and momentum can be chased in ICICI Bank. We are expecting a quick move towards 986. So probably this particular move can be witnessed in today's session itself. The second stock on our radar is ITC. Now the stock was underperforming for a very long time. It has still not participated in the recent rally. If you look at the structure there, it seems to be forming a very strong base near to that 444.45 mark. If you look at the 5 and 20 exponential moving averages, yesterday it has started comfortably trending above it. So we're expecting that this particular move would be a change in trend. The base is very well placed at around 442, so one can place the stop losses there. And from a positional perspective, we are expecting a move towards 460.
All right, ICICI Bank and ITC, two stock recommendations coming in from Sacchitanand. With that, Sacchitanand, thanks a lot for taking our time and joining in as always. It was a pleasure speaking to you, and thanks a lot for addressing all of your queries as well. But before we wrap up for the day, let's also talk about some of the cues to watch out for. IIP and CPI numbers will be declared later today. Of course, watch out for that. And all you Apple lovers, Apple will be holding its most important launch of the year as it gears up to unveil new hardware, including the brand new iPhone 15. The event is scheduled at 10:30 p.m. IST, so watch out for that. Well, with that, it's a wrap on this edition of Morning Trade from me and the entire team. Thanks a lot for tuning in, but of course, stay tuned because coming up next is Opening Bet.